Welcome to this webinar to help improve your knowledge of the local government pension scheme and the main considerations for planning the retirement that you want on your own terms. Let's start by telling you a little bit about who we are. Wesleyan Assurance Society is a mutual, which means it has no shareholders and can keep focus and stay true to the needs of its members and customers, with members being able to choose their own package of benefits. Wesleyan Assurance Society's financial strength comes from its purpose and long-standing way of doing business that has always put its values and the needs of its members and customers ahead of short-term gain. For more than 180 years, it has been creating a brighter financial future across the UK in an ever-changing world. Wesleyan Assurance Society's award-winning in-house team puts investors first, and in 2023 was named Investment Team of the Year at the Insurance Asset Risk Awards. Wesleyan Financial Services is the financial advice arm of Wesleyan Group of companies and is wholly owned by Wesleyan Assurance Society. Exceptional personalized service and strong relationships are provided by specialist financial advisors who deliver tailored financial advice to support society's most trusted professionals. As experts for society's most trusted professionals, we are committed to always having a deep and evolving understanding of everything our customers give to their careers. We can support you with financial advice, products, and services throughout your life and career, from your first steps on the career ladder to buying your first house, protecting your family and valuables, saving for your children's university fees, planning your retirement, or leaving an inheritance to your family, plus lots more in between. This webinar is designed to touch upon how you can get the pension that you need and explain more about the scheme itself. The key areas we will be covering off today are types of membership and the various sections within them, how to increase your benefits, alternative ways of saving for retirement, then finally, what your actions and next steps should be following this webinar.
So let's look now at the local government pension scheme and how it works. It's classed as a defined benefit scheme, which means it doesn't have an immediate cash value. In addition to a pension, the scheme also offers you death in service and family benefits to look after your loved ones in the event of your death while you are still working. Finally, there is a provision for ill health retirement. This means that your pension can be paid early if your employer decides you are permanently unable to do your job due to ill health and you are not immediately able to work in another role. How much do you have to pay into the scheme each year? That depends on your pay. Here is a quick overview. For those who have already opted out of the LGPS or who are considering opting out, there is an option for flexible contributions, the 50/50 section. This means that you can choose to pay half contributions for half the pension, while still retaining the full value of your other benefits, including ill health and death in service. Any member can elect to pay into the 50/50 section at any time. You have to complete a request form and submit it to your employer. It's designed as a short-term option for when times are tough financially. This is why your employer has to re-enroll you back into the main section of the scheme every 3 years, in line with their automatic re-enrollment date. Your employer should inform you when this happens. If you want to continue in the 50/50 section at that point, you have to make another election to remain in that section. You can choose to revert back to the main section of the scheme at any time by informing your employer in writing, and you will then start to build up full benefits in the main section from your next available pay period. Amending contributions to your pension can have an impact on your overall financial future, so please seek advice before undertaking a step such as this. So now moving on to the actual calculations. How your pension is calculated depends on when you joined the LGPS. Each time a new pension scheme is introduced, your membership transfers over from the old scheme and you gain the benefits of the new scheme. Your pension benefits may therefore be made up of several parts as follows. LGPS member before the 1st of April 2008. Your benefits are made up of an annual pension and a lump sum. Your pension is calculated at 1/80th of your average salary for each year of your pensionable employment. This is taxable. You will also receive a lump sum that is 3 times your annual pension. You can also increase this lump sum by converting part of your pension. Each £1 of pension that you convert will create £12 of lump sum. However, this will reduce the annual pension you receive. The maximum lump sum that can be taken is 25% of the capital value of the pension. Membership between the 1st of April 2008 and the 31st of March 2014. For service between the 1st of April 2008 and the 31st of March 2014, you will receive an annual pension calculated at 1/60th of your average salary for each full year of service. This pension is also taxable. You don't automatically get a lump sum. However, you may convert up to a maximum of the total pension value of your benefits into a lump sum, and this will have an impact on your annual pension. The maximum lump sum that can be taken is 25% of the capital value of the pension. Service from the 1st of April 2014. Once you join the career average arrangement, you will receive an annual pension calculated at 1/49th for each year's pensionable pay. This pension is also taxable, and you don't automatically get a lump sum. Again, you may convert up to a maximum of the total pension value of your benefits into a lump sum, and this has an impact on your annual pension. Any benefits you have built up in the old sections prior to the transition to the career average arrangement are preserved. Those benefits will continue to be calculated according to the methods I just explained for the different sections. The maximum lump sum that can be taken is 25% of the capital value of the pension. You may be aware that a number of changes to the LGPS were introduced on the 1st of April 2014. The pension scheme has changed from a final salary to a career average scheme. The way your pension is calculated has also changed as a result of this. Your normal retirement age, which is the age at which you can take your full pension without a reduction, is now linked to the state pension age. We'll go through all of this in more detail in a minute. All pensions that are already in payment or that you've built up before April 2014 will be protected and will still be based on your final salary earned the year prior to leaving the scheme. There are also no changes to the other benefits we just looked at, including death in service, family benefits, and ill health retirement. What is the career average arrangement? It means that your pension will be calculated differently going forward. You will earn a set percentage of your pay as pension each year you work. This goes into your pension pot. Your pension pot continues to be revalued with an indexation percentage until you retire. This is a percentage that is added to your pension each year to adjust for inflation. Benefits accrued prior to entering the career average scheme are protected. In this example, our customer, John, is 50 years of age and has 24 years in the scheme. His average salary across this time period is £20,000. As each new element of the LGPS has been introduced, John's pension has been transferred to the latest arrangement. So his pension is made up of all three elements: the 80th final salary, the 60th final salary, and the care scheme. At Wesleyan, we understand that working in education is demanding, and to that end, retiring early is a key driver for many education professionals. There are several questions that will need to be considered if this is a feasible option for you. The first question to consider is twofold. What exactly counts as retirement, and what is early? We've mentioned this area earlier, and retirement usually means finishing work, but that doesn't necessarily mean putting your feet up for the rest of your life. Perhaps you still want to work and earn in some way, just not in the way you have been. What about early? You can consider early retirement to be any retirement before the normal pension age, but will focus mainly on a retirement that happens for some in their 50s. We have seen more people leaving their profession completely, but in this case, you need to consider how you will be spending your time. The key age for any pensions is currently 55. At this age, you can draw down on any pension you may hold, but you should be aware that this is increasing to age 57 from 2028 and how this could impact your plans. Again, we can help you navigate your way through all these options. This table shows how your benefits may be reduced if you decide to take your pension early. A lump sum reduction only applies if you were a member before the 31st of March 2008. The government changed the reductions on 3rd of July 2023. The reductions shown here apply to retirements from that date. If you're looking at planning and funding your retirement, it doesn't have to be solely carried out through pension vehicles. In fact, retirement planning can be done through a range of different types of assets and plans. Other assets that could support your retirement may include private or workplace pension pots, as well as savings and investments. Another potential is property. You may be looking to downsize or release equity from your home or have other property to let or sell. There are also likely to be other income streams personal to you. State pension will come at a future point, but often there is a gap between retirement from teaching and the receipt of state pension. Partners are a key consideration here also. If you're in a joint household, how does your pension work with theirs? Joint reviews add value to anyone's financial planning where there is a partner. With all of these factors considered, you can work out whether your combined assets will be enough to generate sufficient income over the length of your retirement.
Until April 2016, the local government pension scheme automatically contracted members out of the additional state pension, allowing both employer and employee to pay lower national insurance contributions. The state pension and additional state pension have now been replaced by the flat rate state pension. An individual's national insurance record will be used to calculate the single tier state pension, a year in which an individual has paid the necessary national insurance contributions is known as qualifying years. Those with less than 35 qualifying years will receive a pro rata amount of pension, subject to them having at least 10 qualifying years. The single tier state pension will be determined individually with a starting amount for each individual at April 2016, which takes into account their existing national insurance record and make deductions for the time the individual was contracted out. Spouses, registered civil partners, will no longer be able to inherit rights from their partner's national insurance record. To sum up, the current flat rate state pension is £230.25 per week, and you will need 35 years qualifying national insurance contributions to be able to access this. In line with reviewing your LGPS figures, it is wise to obtain an online forecast of your state pension. If there are any gaps or you are behind the 35 years service, there are ways you can make additional voluntary contributions through Class 3 national insurance payments. This is something you will need advice with that we can discuss together to ensure you are maximizing the opportunities available to you.
Whatever your pension age or access stage, you must fully understand the pension you need. In a previous section, we talked about financial independence. What does this really mean? All this means is that your outgoings over the rest of your life don't exceed your income and savings. Once you put it in those stark terms, you can break your ambition down into goals. First, paying off any debts. Clearing these will only help as less stress on the expenditure in retirement. A big part of this may mean paying off your mortgage. It's likely to also be the biggest monthly expense, and therefore the biggest saving when wanting to retire early. You need to work out your income needs in retirement to ensure your daily needs are covered, plus any other outgoings. You'll need to work out the minimum you'll need to spend each year to have the lifestyle you want. For the moment, forget things like luxuries and holidays. They will come later. First, get down your basic budget for essentials. It's sensible to suppose your basic needs won't change much. However, you should be able to deduct regular expenses, such as mortgage repayments and any servicing debt, assuming that you've dealt with those issues above. You can also discount any necessary expenses that's specifically related to your working life, such as daily travel costs. Similarly, if you have children, they are likely to be grown up by then. Though they may still need financial help from you, this will count as discretionary spending. So, deduct child-related costs for now. You should aim to arrive at a single monthly and yearly figure for your essentials. Remember that costs will rise gradually with inflation year on year. Also, consider that in your final years, you may need to find money to pay for care. You'll then need to consider your additional funds so you can really enjoy life. This becomes your discretionary spending in retirement. This may be the hardest figure to estimate. You'll need to think in detail about your plans for retirement, where you want to live, how many holidays you'll take, what interests you'll pursue, even what vehicles you want to own. Maybe you've always dreamed of owning your own boat. This can be called discretionary spending. Again, assume that your costs will rise with inflation over time, but also that your lifestyle may modify in later life as you slow down. It's important to estimate your total costs over retirement, combining your essential and discretionary spending. You now need to judge whether your assets can meet two different targets: essentials only or essentials plus discretionary spending. Now, estimate the length of your retirement. If you're retiring age 55, then 30 years is a reasonable figure. The next step is to find out whether your assets can cover those levels for spending over this longer term. The other side to this is calculating what income you can achieve in retirement. Make an inventory of all your assets to see where your retirement income could come from. Assets may include private or workplace pension pots, including those that may be final salary based. In this video, you will see how a specialist financial advisor from Wesleyan Financial Services would use a cash flow model as part of the advice process, which can help you put together a financial plan that may make your money work harder in the short, medium, and long term. This planning can be broken down into 5 simple steps, We'll then develop a tailored plan to achieve these goals and set out the specific action you need to take.
Do you know what the potential of your financial future is? It's understandable if the what-ifs are completely overwhelming. We've developed the Cash Flow Modeler tool to help you build a realistic and informed financial plan of your income and outgoings for both now and in the future. Our customisable tool helps you visualise your life in numbers. It'll identify risks, play out different scenarios and sketch out a financial roadmap for what your next steps are and what happens if you don't do them. Seeing your future in numbers can empower you to answer questions such as, when's the earliest that I can retire? How can you achieve your dream retirement goals? Or show you how to pass your wealth on to your family tax efficiently. The Cashflow Modeler tool means you don't need to compromise or rush your decisions for your retirement. It allows you to test all the variables, compare investments, and show you if you're moving in the right direction. It accounts for high or low inflation, different pension and investment performances, and can incorporate any major life changes that might pop up. No matter what your age, don't leave the path you travel to chance. Plot out your desired outcome and the Wesleyan Cashflow Modeler tool will show you the best way to achieve it, putting your future firmly back in your hands. Wherever you are on life's journey, Wesleyan will be with you every step of the way.
Other assets that could support your retirement may include private or workplace pension pots, as well as savings and investments. Another potential is property. You may be looking to downsize or release equity from your home or have other property to let or sell. These are also likely to be other income streams personal to you. State pension will come at a future point, but often there is a gap between retirement from teaching and the receipt of state pension. Partners are a key consideration here also. If you run a joint household, how does your pension work with theirs? Joint reviews add value to anyone's financial planning where there is a partner. With all these factors considered, you can work out whether your combined assets will be enough to generate sufficient income over the length of your retirement. Overall, your income needs can be met in a flexible way by considering what assets you have and how and when they can best be utilized. Tax is a big consideration here, as is the type of asset you hold. Specialist advice, in conjunction with cash flow modeling and pinpointing objectives, can assist you with the building of your bespoke strategy. What if you don't have investments? A number of people have accrued cash but have never invested. What is the difference? Money has only got a value when you spend it. If you are not going to spend it today, but you are going to spend it next year, then if the goods or services that you want to buy are more expensive next year, then you can buy less goods and services. The goal of investing is for your money to keep pace with inflation, so you can buy the same number of goods or services. Or to grow at higher than inflation, so your money can buy more goods and services. The challenge is for savers to ensure their savings are outgrowing inflation rates. The money you hold onto as cash slowly loses its buying power due to inflation. However, by investing, you can expect to achieve high returns over time with the aim of at least beating inflation. You may ask why there is any risk in having cash deposits at all. The risk here lies in inflation itself. Assuming that the inflation rate is around 2% based on a long-term period, if you put £10,000 into a bank account with 0% interest, this would only be worth £9,804 in 1 year's time, £9,057 in 5 years' time, £8,203 in 10 years' time. So, If you don't put your money into savings or investments where the interest rate outstrips inflation, your fund could potentially lose money.
So, what should you do now? Decide which retirement is right for you, know how and when to apply for your benefits, consider carefully the options you have and how to take your benefits, understand lump sum investments products you may need to consider, look at your options for returning to work, how we will provide advice to you, agree needs and services, whatever they may be. We will then gather the data, analyze the requirements, and then we will present it to you and discuss your pathway. So, what's next? You can see from our discussion, this is a complex area with lots of key considerations. That's why it is important to develop your retirement planning strategy as soon as possible to maximize the number of opportunities you have. We recommend that your first step is to arrange a conversation with our local specialist financial advisor. Step 2 is to discuss your unique financial planning needs and to assess what you can do now to start maximizing the amount you have at retirement. Step 3 is us working together to develop and, most importantly, maintain your strategic financial plan. Charges may apply. We will not charge you until you have agreed the services you require and the associated costs. I hope you find this useful. Thank you for watching.